Welcome back, everybody. Mark Panazon here, partner and mortgage broker with Mortgage Connection. This is your August monthly market update. I have a number of things to get through today, so without further ado, let's get started. The first item on the agenda here is the 5-year bond yield, aka fixed rates. So we've seen a really nice pattern of fixed rates moving down since the peak of around October of last year. You can see it's following this downward channel, or we call this a bear flag in stock trading. Regardless, the bond yields have been dipping quite a bit, obviously with the news of inflation dropping, and then therefore the Bank of Canada dropping the overnight lending rate. You can see the blue line here is the 200-day moving average, and we're now officially under it as of May. It tried to sort of bounce back up and has since retreated. So this is fantastic news for fixed rates in the short term and medium term. If we zoom out here and if I show you the weekly chart, you'll see that the trend here over the course of the last 50 years or so has been good. It's been down. So a downward move here for interest rates since 1986-ish. We've had this obviously rise in interest rates through post-pandemic and the crazy high inflation that we've all experienced, which I can show you right here. So with this inflation now tempering way back down, fixed rates have definitely peaked, and now we're just continuing to see them drop. And as we continue to drop the overnight lending rate, which is the Bank of Canada rate here, which impacts variable rates only, you'll further see fixed rates and now variable rates continue to drop. Which brings us to the sort of the next chart, which is inflation, which drives everything. So recent numbers that just came out today are that inflation's down to 2.5%. And we haven't been this low since 2021 of March. So fantastic news. We are already in the band of 1 to 3% of inflation. That's where the Bank of Canada likes it, preferably at 2. But no less, we're certainly trending downward. And if you look at the historical, even the 10-year, you can see we made this big move up post-COVID, and now we're making our way back down, which is with historic trends here. You can see we're all around 2% during that time. So inflation's coming back down. I don't think we're going to be going back up anytime soon. So this is fantastic news. When you look at the Bank of Canada overnight rate, we've now had 2 rate drops. We were at 5%. They dropped it to 4.75, and then they dropped it down to 4.5%. There are 3 more Bank of Canada meetings this year, and if inflation continues on this path, we can expect the bank to act on potentially every rate decision. So, it's very likely that on September 5th is the next meeting, that we'll see another quarter point drop. The overnight rate will go down to 4.25%, which means all your variable rate mortgages, home equity lines of credit, unsecured car loans, things like that will all drop by the equivalent of 0.25%. So more money in our pockets. So that's good news. I want to switch to the monetary policy report. So this hasn't changed. The Bank of Canada has confirmed that the overnight rate, which was 5% in April, will be down to 4%. That's their projection, or at least the median number of responses, and then down another percent to 3%. So this hasn't changed in the past few months. The good news is the bank is actually now acting on these meetings. So we're down to 4.5%. The next meeting's in July. The projection was a hold, but I do think we're going to see it down to 4.25, and then we'll see what happens by the end of the year. We might even be down to 3.75 by December if inflation continues to drop. Now, what about housing activity? Well, this story hasn't changed much. Housing starts are up. So we were about 280,000 homes were built in July, which obviously is fantastic in terms of the year over year. But when you look at the max numbers, this still isn't enough homes. We're still building the same amount of homes that we were building in the 70s. You can see in 1978, we built 281,000, yet we have about twice as many people in Canada. So good short-term number, but we still need to increase this number quite a bit. And there's layers and layers in how we can do that. I'm probably not the guy to explain it, but I think by getting more jobs, more construction jobs is probably a good place to start. If we have more workers building more homes, we'll have more homes. And then the population piece is also the other part of this problem. So we're building considerable, well, about the same amount of homes we've built over the last year. But when it comes to population, um, we're still bringing in a ton of people. Here's the year over year sort of population numbers. So this time last year, we had about 39.7 million people in Canada. We now have 41 million people. So that's roughly 1.2 million people we've immigrated to Canada in this past year. In my view, that's just way too many. If we have this massive housing problem, we're not building enough homes, and we just keep bringing people in, they're going to need homes. So I don't think this thing is really any different. We're still bringing in people. We're not building enough homes. We'll see what happens. Home sales. We're a bit of a slow summer. 38,000 units in July, 38,000 in June. I don't know if this is ramping up like historic trends. You can see here over the last 10 years, we've kind of just been muddling along since that sort of post-pandemic high where we were building around selling about 63,000 homes in March. That was certainly the peak. We've now leveled off, which is probably consistent with previous years. If you go way back, you can see it's pretty consistent. So sales have kind of leveled off. It's kind of a stable market again in Canada. If you look at the house prices have come down as well. They were sort of peaked around 750,000 in August of last year. We're down to 720,000. Not a massive drop, but again, if you look at the sort of historic trends here, sort of seemed to peak in March of 22. That was that post-COVID high, and now we've kind of come back down. Now, obviously, house prices over the long term are way up. Average house was 240,000 in 2005, so it's still fairly unaffordable, which goes back to the how many homes can we build a year, how many people are immigrating into Canada. So still kind of a problem, but at least we've seen some relief since the pandemic. Hopefully things will level off. Also important to look at the employment rates. This is a good metric for determining if rates go up and down. So overall, still fairly high at 6.4%, not really changed, not changed at all from last month, and obviously trending upwards. That was extra motivation for the Bank of Canada to cut rates. If you look over the sort of long term, same kind of story here. We had this crazy number in COVID, 13% of unemployed. We've halved it, but we've really been trending up since April of last year, and that I think is probably a pretty good figure to have the Bank of Canada start cutting rates, which they have certainly done. If you want to break down the employment a little bit more, it's important to look at part-time and full-time employment. So we had a bunch of gains in May. 62,000 Canadians were part-time, and you look at this month here, we've actually lost 64,000 part-time jobs, but we've gained 61,000 full-time jobs. So a lot of people sort of seem to be part-time last month, and a lot more people are full-time all of a sudden. So that could be for a number of reasons. Could be that the costs are still high and adding up for people, and they can't afford to work part-time, so now they may gotta work full-time. I was suspecting that perhaps a lot of the boomers were retiring and taking part-time jobs, but maybe not. Maybe they were taking the summer off, or maybe influx of people into Canada with part-time jobs. Hard to say, but either way, the number is up. If you look back in time, nothing too crazy here. 61,000 in July. There was that peak in COVID of 500,000, but it's kind of hovered around, 40,000-ish around there. So interesting numbers on the unemployment figures. Now, lastly, I'd like to go over the rates, of course. That's why we're all here. So let's get a touch on the interest rate. So if I back up just a little bit, we know that rates have been coming down. So obviously we peaked in October, but if we're talking month over month, the bond yield now is 2.9% as of today, and last month it was around 3.1. So there should be at least a 0.2 drop in rates month over month. Let's take a look. So when we're talking end to end, the lowest rate you can get for anything is this 4.34% product with Marathon. It's a 6-month product, a 6-month fixed mortgage, so it's a bit deceiving. It's not a long-term deal, but if you're thinking short-term and if rates continue to drop, it's not a bad product to start considering. You get the ultimate lowest rate for 6 months. You do have to recommit to Marathon after that to avoid penalties, and I believe you have to sign at least a 3-year term with Marathon to carry on. Otherwise, they charge you 1% penalty, but no less. 4.3% is certainly the lowest that we've seen in a while. If we start now sort of filtering in some of these numbers, you can look at this, the 1 year term, which is 6.59%, which would be the lowest with ATB. Now, obviously, quite a bit higher, and I think this is probably no coincidence that fixed rates and variable rates will be lower in a year. So I do think banks are trying to take advantage of that that information. And if you are thinking short term, they want to take advantage of that and charge you higher rates. So not ideal, 6.5% to 7.5% in that range. If you look at the 2 year, or a little bit better at 5% now, 5.1. It still goes up to 7, so there's a good band in there. But you can still certainly secure 5.1 on a 2 year, which is okay. The 3 year has been the sweet spot this whole time. It's not as much of a change here, but 4.5% is not too bad for 3 years. It's slightly higher than the 6 month. But if you're thinking short term, you want stability, you don't want to go with a variable just yet, and you certainly don't want to pay 6.5% on a 1 year term, then the 3 year is still a pretty good plan. So that's available out there. If you look at the 4 year, it's going to be just a little bit higher. So the 4 year is now 4.69 all the way to 6% with Canadian Western Bank. So Strive, CMLS, RFA, all these guys are offering more or less the same product. So 4.69, not bad on a 4 year. And then the coveted 5 year fixed, which is traditionally the lowest rate, is hovering around 4.49 all the way up to 4.8. So again, you could just take the rate for 5 years, or you could take it for 6 months and reassess. Seems like it would make more sense to maybe take that 6 month rate instead of locking in for 5 years if you believe rates will continue to drop in the future. Nonetheless, let's throw it on the list here. So 4.5%. And then we do have, I don't know if we have any 6s. We have 1, probably not worth mentioning. I don't think you're going to go anything longer than 6 years. 6%, 5.5% for a 7 year or a 10 year. Just wouldn't be a good idea to lock in for any of these fixed rate terms. But then we do have the variable rates. So variable rates are chunking down. Obviously, the Bank of Canada is the main figure that determines if rates come down or not. It's not like the fixed rates with bond yields. So 5.5% all the way up to 6.5%. So we're getting there. They're certainly not cheaper than fixed rate mortgages. As per this chart here, variable is still quite a bit elevated, where traditionally that hasn't been the case. The variable, or red, has traditionally been lower. So we're still inverted, but we're working our way down. And I do believe that variable rates will be lower than fixed rates in the next year to 2 years, I'd say. So deciding to take a variable rate now, overpaying a little bit, might be worth the risk if your risk tolerance is low. But if your risk tolerance is high, you may want to secure that fixed rate, like I said, for maybe 6 months or 3 years, and just take that security now if you're worried about price fluctuations or rate changes. So we kind of just do a quick summary of the rates here. 4.3 for the absolute lowest, shortest term possible. Then it works to the 5 year fixed. The 3 years, kind of that sweet spot, are still around the same rate, 4.5%. The 4 and the 2, you can debate, and then you got that variable, and the 1 year is the highest. So I think honestly, the probably things I would recommend, depending on your situation, every mortgage is different, every client's different. Every circumstance is different, but in general, I would say you can take the lowest rate overall, which is probably the 6 or the 5. Totally different terms, but depends on what you believe in. Or you take the middle ground at a 3 year fixed, a guaranteed rate for 3 years, or you roll the dice and go with that variable, which is a percent higher. But if you remember the rate cuts that should ensue, we're at 4.5% now, which should be 4 by the end of the year, and should be 3, which means we'll get a 1.5% drop by the end of next year, potentially. If that's the case, this rate will be closer to 4% by the end of next year, which would obviously be lower than anything you take, even that short-term fixed. So we're moving in the right direction. Certainly not at pre-COVID rates. We may never be at pre-COVID rates, which were around 3.5%, but we're certainly making our way there. And I think with the sales activity being a little bit flat, I think people are waiting a little bit on the sidelines before making a splash. Plus, the supply is still fairly constrained with the high population, low building starts or housing starts. So there's just not that many homes for sale either. Being in Edmonton here, we can certainly see the migration and immigration into Alberta. So there's a lot more people, certainly in Edmonton and Calgary, which kind of brings up the very last thing I want to show, which is sort of some of the housing numbers for Canada, but specifically for the two markets I cover, which are Alberta and BC. You'll notice in Edmonton, pretty reasonable growth over the last 5 years, only 15%. This isn't a wild market here. Average price still just under 400,000, and very modest growth over the last 3, 6, 12 months. So pretty stable, and prices still very affordable, and people certainly are waiting on the sidelines, not diving full in yet. I think people might be waiting for the rates to really sort of bottom out. But nonetheless, great time to buy in Edmonton. Prices are really low, rates are coming down. Just have a good strategy, and it would be a good price. Calgary is really getting out of hand. So 40% over the last 5 years. They're starting to sort of compete with those bigger BC market cities. 40% over the last 5 years. 28% over the last 3 years. Slow over the last 6 months. I think that wave has sort of slowed down, and it's also summer, so usually activity is a little bit slower in the summer. But nonetheless, 580,000 for a home in Calgary. Then you have all these different areas in BC. The city I used to live in, Victoria, is at 862, which is almost exactly the same growth as Calgary, up 40% over the last 5 years. You can look at the lower mainland, just about 1.1 million. Greater Vancouver, 1.1 million. Right on the same growth, 35 to 39%. Tell you, BC real estate is just like gold. It's just available everywhere. Just dig. So BC is looking healthy. Calgary has had a big boom. Edmonton's still very modest and stable. Still a great place to call home. Great place to buy a home. Still very affordable. If you compare it to some of the other markets, it's slightly more than Saskatchewan, but look at Saskatoon at 398. So, you get a much bigger city in Edmonton and slightly cheaper, which is interesting. So even Saskatoon's a little bit ballooned right now. So that's what I have for you this week. Hopefully this information's been helpful. If you have any questions regarding your specific situation, please send me an email at mark@mortgageconnection.ca. Otherwise, have yourselves a great week, and we'll see you next month.